what I'm talking about, well, this is what we've been explaining to you. That the three readings for 2021 were going to be replaced by the readings in 2022 that would likely be higher, sending the year over year now to 6.6 from 5.9%. And that's what's disturbing the markets because it hates inflation. But the dawn is coming. And as we've been saying to you, it will start to get better. Well, inflation should naturally start to come down anyway on the month over month readings due to the fact that the Fed hikes are going to start to bite. Goods are starting to flow. We should see some relief. And as you'll hear later, even the job market starting to show some little signs of weakness. But when we take a look at what's to be expected, the future readings that will be replaced are at elevated levels. It should be a lot easier to see much lower future reports come in and bring this inflation reading down between, we'll get this reading on November 10th. So yes, we could have some turbulence between now and then, but we should start to see some relief. And eventually, I think things will start to feel a lot better. The good news is coming. The worst is now over. The part that we had feared, the part that we had warned about, it's now over. And listen, as we've said before, there's a big difference in us warning you that this was coming, telling you that this was coming, and actually living through it. We get it. But this was to be expected. No surprises here. In fact, we've been locking ahead of this particular number, as you know, since last Thursday. So it's been a week in advance of locking. And guess what? About 250 to depending on where the market settles in, but 250 to 275 basis points saved in price between last Thursday and now. So we definitely warned our customers and deserve some good credit for that. However, unfortunately, it is a small consolation given where the market is right now. But your customers should be feeling pretty good and appreciate the good advice that you have been given. Now, when we take a look at going forward, there are a few things, and Dan, some of the things I want you to break down in that CPI report, specifically on the rent side.
Yeah, Barry, it's crazy to see the core rate of inflation just 3 months ago going from 5.9 to now 6.6%, definitely going in the wrong direction. Rental costs here were certainly a big part of it. They were up 0.8% last month, and they're now up a little over 7% year over year. But remember, this is a lagging indicator because of the way that they calculate it. When we look at more real-time numbers in the market, for instance, from Realtor.com this morning, they showed that rents are up as of September 7.8% year over year. Now, while that is the lowest reading in 16 months on a year-over-year basis, still more than double pre-COVID figures. But this goes to show you that we do have on the horizon inflation probably coming down as the CPI numbers catch up to more real-time indicators as far as rental prices are.
Yeah, Dan, I wanted to add to that. I love that point you made because you're right. Rents are going to start to come down. And while it takes a little time, that's just another reason why we should, because as we all know, rents make up about 25% of CPI. So it's got a very heavy weighting, and that should help us.
And we also got the Fed minutes yesterday from that September 22nd Fed meeting. And this showed the Fed mostly hawkish, talking tough, saying that they need to continue to hike even as the labor market slows. They said the risks of doing too little outweigh the risks of doing too much. Now, there was a slight dovish undertone where some of the members did say, we need to contemplate the pace and acceleration of our rate hikes here and calibrate that with the adverse effects to the economy. But boy, after today's inflation reading, you got to believe that the Fed is going to go full steam ahead.
And speaking of the labor market, today we got initial jobless claims, which rose once again by 9,000 to 228,000. This is the second consecutive week of increases. And although these numbers are still historically low, we will continue to monitor this as an increase in the pace of firings is a precursor to a higher unemployment rate, which would be a canary in the coal line for a recession to come, which would certainly help with inflation.
Yes, it is dark numbers today, but we hope that we come around here pretty soon. The next inflation reading that we're going to get for October, once again, November 10th. It's not that far away, and I do think we'll start to see some benefit and relief start to trickle in a little bit in advance of that.